Hi, Darius. Thanks for joining. First one in the room. Hello, Andrew and Peter. Hello, Satish. We'll give people a couple of minutes to get into the room. Hi, David, Steve. Everybody's rolling in now. We've got quite a few people registered for today's webinar, about 60 odd. So it might take a few extra minutes for everybody to get in. I'll try to keep track of everyone joining so I can say hello. Karen, Joe, Gian. As I say, it usually takes people a couple of minutes to enter the room, as I know that Zoom can be a little bit clunky sometimes. So we'll just give them those couple of minutes and then we will get started. Thanks for joining Will, David, Sandra, Christopher. Thanks for joining. No worries, Darius, but that's a good point. Guys, can you please just let me know that you can see and hear me okay? Using the chat function, which should be at the bottom center of your screen. Just click on chat and you should be able to interact with me. Great, thank you, Steve. Excellent, thank you, everyone. Good stuff. Well, as I say, we've got about 60 odd people registered to today's webinar. We've currently got 17. So I'm just going to give them a couple of minutes to get in so that everybody can get all of the content and we'll get underway. First off, I apologize for the big scratch on my forehead. I walked into a branch at the park with my daughter a couple of days ago. Hello, Brian. Thanks for joining. I'm kind of losing track of the people joining now, but I'll keep doing my best. Hope everyone's had a productive morning. Assume most people are still working from home, as are we. All right, quite a few more people entering now. Just give them a couple of minutes so that everybody's in the room before we get started. All right, well, what we're going to do is just get started with some of the prelim things on the webinar, and then I'm sure more people will join us as we're going. So first off, I'm Paul Mahoney. I'm the founder and managing director at Nova Financial Group. We're a property investment advisory company. Today's talk will be on how to passively build a property portfolio so that you don't have to work forever, which, you know, so far as not having to work forever, that's generally the goal that most people have when it comes to investing in anything, not just property. And we'll talk a bit about that specifically and then why we feel that leveraged property investment is a good way of achieving that. I'm much more accustomed to doing these talks face-to-face rather than via webinar. However, obviously, given our current situation with COVID-19 and working from home and all that sort of stuff, we have been doing a lot more webinars since the start of lockdown. So we've been doing 2 a week, every week, and we mix up the topics a little bit. So we've got another one next week with a different topic. So feel free to register for that one as well, which I'm sure you'll be emailed about over the coming days. I always like to try to, even though it is a webinar, I like to try to make it as interactive as I can. So I've got a couple of questions to ask you all before we get started. And then I'll tell you a little bit about me and our business as well so that you understand you know, who you're listening to. But I suppose, first off, I'd like to get a bit of a read of the room so far as the people that I'm speaking with. So if you were to categorize yourself between a beginner, intermediate, or more experienced investor, where would you place yourself on that scale? If you don't mind just responding to me in the chat section. For those who have just joined, that should be at the bottom center of your screen. If you just click on chat, then you should be able to interact with me. Okay, medium, intermediate, beginner. Medium, intermediate, some experience. Okay, beginner. All right, so a bit of a spread. That's always good because I hope there's some content here that is useful for everyone. Experience, okay, good stuff. Obviously, that's the whole point of these webinars, is to offer value to you. And I assume that everybody that is attending is wanting something from it. You know, you're giving up some of your time, which is great, and I thank you for that. So my next question is, what is the main thing that you would like from this webinar? You know, the main reason for attending and the main thing that you would like to walk away with that perhaps you didn't walk in with. What's the main thing you would like from the webinar? If you don't mind just commenting that in the chat section for me now. Thoughts and ideas. Want to diversify, building a larger portfolio, a couple of beginners. Some info based on the current climate. Okay, we can certainly talk on that. Understanding the mechanics of investing in property, time, costs, and yields. Basic understanding of the topic, developing a more profitable financial model. Okay, good stuff. Understanding EWS1. Okay, Steve, a bit more of a specific topic there, which I would be happy to discuss with you. Not really relevant to this webinar, but happy to discuss that with you later on. Property investment with little or no deposit. Okay, advice on current property market. All right, all good points, some of which we will cover in this webinar. Understanding how to make a profit this time, I assume you meant there. Learning how to build a portfolio to achieve passive income in later years. Is it really a profitable venture in today's climate at all? How to source funds. All right, all good points. Now, some of those, and I'll tell you which ones, I would like you to copy and paste over into the Q&A section. So at the bottom left of your screen, there's a tab that says Q&A, and that is what I will come back to at the end of the talk. So, of course, I can't cover everything with regards to property investment in this one talk because we would be here forever. I will cover things specific to this topic, and hopefully there's some value there for everyone. However, there's some really good points here. For example, Addy, is it really profitable and can you make it work? We'll cover some of that in the talk, but if you don't mind copying and pasting that over into the Q&A section. Paul, you mentioned advice on the current property market. Another great point. Please copy and paste that over into the Q&A section. In my experience with these webinars, the most value has come from the Q&A sections because it's what's relevant to you. And I think you will find that the questions you're asking aren't just relevant to you, they'll also be relevant to others. So please do ask as many questions as you can. I'll come back to them at the end. The most successful webinar we've had for questions is we had nearly 100 people registered and we had 59 questions. So that webinar went on for about 2 hours, but that's okay. As I say, what this is all about is offering you value. So any of those points that you would definitely like me to cover, copy and paste them over into the Q&A section, and I will come back to them at the end of the talk. Okay, great, good stuff. So I suppose first off, just a little bit about me. So my background, I previously ran a large financial services company in Australia, which was full service financial planning, and property formed part of that. I was there for 4 or 5 years, publicly listed that company. I left the company, came to the UK and started Nova. And Nova Financial Group is a financial advisory company. However, we strongly specialize in property as the vehicle for creating and storing wealth. Talk to you a little bit more about that in a moment once we get into the slides. But myself, I've invested in pretty much everything there is to invest in. I've got a reasonably sized property portfolio in the UK, and I'm continuing to invest. I've done a bit of property development and I'm continuing down that path as well. And I've also written a best-selling book, which is, hopefully you can see that. I know the background kind of cuts it out a little bit, but it's a bestseller on Amazon in the UK and Australia. And I'll send you all a link at the end of the talk as to how you can get that for free. And it just covers all of the points that I've gone through in this webinar in a lot more detail. Really good question there as to how we are going to make money from a free webinar. This webinar isn't about making money. It's about offering you value. And if you can see some value in working with us, then great. And then if you do see that value and we do work together, then perhaps there's a mutually beneficial relationship that exists there. That's what these are all about, offering you value and determining who we might be able to work with. So hopefully that answers your question. Right, so that's a bit about me. So based upon what I've said there, hopefully I know a thing or two about investing in property, creating wealth and building a portfolio. And that's really what this talk is all about. So what I'll do now is share my screen with you. Right. So as I mentioned, the topic of today's talk is how to build a property portfolio so that you don't have to work forever. A little bit of a housekeeping to start with. We are a regulated company, so it's important for me to say that anything that I cover in today's talk is general in nature. It's not specific to you. You shouldn't necessarily act upon it. You should seek personal advice before making changes to your finances or investments. And it just so happens that we can help you with that on a one-to-one basis when we've actually engaged with you to give you advice. So that's important. So we will cover quite a lot of information in this. And for those who are beginners or aren't familiar with property investment overly, there might be some terminology that doesn't make sense. But as I said, if that is the case, then please just ask. Ask the question. That's what the Q&A section is there for. And I'm happy to spend as much time as it takes to make sure that everybody is clear on what I've covered. Further to that, everybody will be offered an opportunity to have a free one-to-one consultation with one of our senior client advisors. That will be a full review of your current situation, both from a financial and property perspective. You'll get more of an understanding of our company and to determine together if there's a fit there. So if there's more personal questions you'd like to cover, or you would like to better understand your current situation, your goals and preferences, and how you might be able to improve, that could be very useful for you. And I'll also cover at the end a promotional offer where we're going to waive our fees. I'll talk to you more about that at the end. But if anyone does feel like they're kind of drinking from a fire hydrant here, don't worry, because there's plenty of opportunity to clarify things. Right, so the agenda. So I've spoke to you about us. I've very briefly covered Nova, but I'll cover us in a little bit more detail so that you understand the direction from which we're approaching this. I think that's important to start with so that you see the logic behind what I'm talking about. We'll then talk about why leveraged property. The key word there being leverage, the ability for debt. And that's really what makes property such an attractive and profitable proposition in any market. Relating that back to some of your questions about the current market and whether it's profitable. Yes, it absolutely is. And the reason for that is you don't have to do very well on the asset returns to do really well on your cash. I'll cover that in more detail in a sec. Investment options. So what are your investment options and how do they compare to property? We'll cover that over a historical period and talk to you again about why leveraged property is in our opinion, far better for a broader range of people overall. Why buy-to-let for business owners? Now, I know that the Festival of Enterprise did a bit of marketing for this webinar, so I assume some of you have come to us from that, and therefore I assume some of you are business owners. In this part of the talk, I'll talk to you about why building a property portfolio or a property business alongside your main business can be a really good idea. And that's coming from somebody who has done it with personal experience and has achieved some very good outcomes. What types of properties work best for passive investors? The snowball effect, which essentially is the self-perpetuating growth that you can achieve from property and how you can turn 1 into 2, 2 into 4, 4 into 8 without really injecting any further cash. How many properties you might need, which is a bit of a trick question. And then at the end, I'll talk to you about the free consultation and advice and of course, answer your questions. So we'll get into some of the content. So first off, us, Nova Financial Group, which effectively is the overarching brand under which a number of different companies fit that all kind of work together for our clients. How we work is we first help clients assess their current situation and their goals. So what's point A? Where are you now? What's point B? Where do you want to be? And what's the time frame and the best strategy for getting from point A to point B? Good question, Addy. So for non-business owners, there are still some very relevant points there. So that section is, some of it is just for business owners. However, it also relates to employees who want to start a property business. So there will be some relevant points there. Right. So what's point A, what's point B, how are we going to get there? Then actually implementing the most suitable strategy. So we do the research and due diligence that goes into sourcing the best properties in the best locations and providing all the research and logic to our clients as to why. So sourcing the properties, we have an in-house mortgage brokerage of which I am the principal. So we advise on and arrange the finance. We provide property management services UK-wide at a below market rate. And then we work with our clients on an ongoing basis to review and reinvest their funds as it makes sense to do so, to build the portfolio and to achieve the goals. I think one of the biggest points of difference that we offer is that we very much take a financial advice and financial planning approach to property. So it's not about the properties. It's not about, the great garden that faces southeast. We don't care about that so much unless it's relevant to making it a good investment. It's much more about the financial outcomes that relate to your specific situation. So we're very unemotional and commercially minded when it comes to property investment. It's not, we don't care what type of property it is or what it looks like. It's all about what makes sense as an investment and what's going to make money. And I think a lot of people get confused between those two things when it comes to property, especially because a lot of people have personal preferences when it comes to property, but they don't matter when it comes to investing. It's all about the preferences of your target market. We're also independent, so we don't have a book or a list of properties that we're trying to sell like most other companies in the industry do. We're independent, so everything we do is bespoke to you as the individual, and we source properties most specific to you. We offer an end-to-end service, so we bring in-house a range of different services where quite often you would need to be dealing with 4 or 5 different businesses to get those services. They're all in the one place, so it gets them all working together. Qualifications and experience. Well, I've talked to you a little bit about my experience. I'm also a qualified financial advisor and mortgage advisor, and I'm supported by a team with over 100 years of experience in the industry across property and financial services. So hopefully we know a thing or two about what we're doing. We have very strong relationships throughout the UK property market, which is important. Our clients invest on average about 30 properties a month through us. So that gives us leverage and buying power, and we can position our clients in the best possible way. We've also been operating for nearly 6 years and have a very good reputation in the market, which is something that can be difficult to maintain as an advisory business, and shows that we've been doing the right thing by the vast majority of people. Right, so why leverage property? Now, I said before about getting average returns on the asset value and getting really good returns on your cash. So let's use an example. I can take £50,000 and buy a £200,000 property using a 75% loan to value mortgage. And by doing that, I can achieve relatively average returns on the property value and get really good returns on my cash. So let's put some numbers to that. From a yield perspective, what we currently aim for in the current market is a net yield on funds applied being the 50 grand as opposed to the 200, because the 200 is almost irrelevant. That's just the value of the property. The 50 grand is what you're actually investing out of your own pocket. Hopefully that makes sense to everyone. With that 50 grand, you could put it in the bank. You could invest it in stocks and shares. You could reinvest it in your business. In this case, we've decided to invest it in property with leverage. So we're aiming for a 5 to 10% net yield on that 50 grand, which is very achievable in the current market. We would very rarely look at anything under 5%, and usually it's somewhere between 5 or 10, sometimes a little bit more. So that gives us a good buffer and creates safety. On the 50 grand, that's £2,500 to £5,000 of net cash flow pre-tax. So post all expenses, after covering your mortgage, your management, your service charges, whatever goes into managing that property, that's post all expenses pre-tax. So that's a nice safety net, a nice little buffer, but it's not really the reason for investing, especially not initially when we're looking to build the portfolio. That's not going to change your life. What might change your life and can change your life is capital growth. Now, the UK average for capital growth over the past 20 years per annum, so per year, is 5.5%. That includes 2 recessions. So we had one in 99-2000 being the dot-com bubble. We had another one in 2008-2009 being the credit crunch. A little bit of a dip in the market there, but not too much. And then overall, we're still at 5.5% positive over that 20 years per annum. So if we scale that back slightly to 5%, be a little bit more conservative and much more achievable, 5% on the asset value being the £200,000 is 20% on the cash we've invested, being the £50,000. Let me put that another way. A £200,000 asset that increases in value to 210,000, so a 10 grand uplift in value or equity created, is a 20% return on the 50 grand that we've invested. And the way that we access that return, so Addy has just asked 5% even at the current recession. Now, the current recession, Addy, is almost irrelevant. I'm glad you've asked that point. It's almost irrelevant because we're not looking at it on a year-by-year basis. Property investment is a 7 to 10 year plus investment. Now, as we know, even if we have a recession, and even if we have minus 5% this year and 2% next year and 8% the year after that, the market will recover. So if we're investing in good properties, in good locations, recessions are relatively short term. So we need to see beyond our nose a little bit and look at it more long term. And yes, 5% over the next 10 plus years is very, very achievable. In fact, you'd be doing poorly, I would say, if you've invested in a good property in a really good location and you only get 5%. That would be about the average. We're obviously looking to hopefully outperform that. But yes, 5% is definitely still achievable in the current market, but year by year doesn't matter. Okay, so back to the point. That's 20% on your cash. Now, the way we access that equity is by remortgaging and reinvesting. Okay, so you remortgage the property, release the equity, and you buy another property. So let's look at these figures. So we've got 5 to 10% yield. We've got 20% growth. If we put them together, we're at 25 to 30% returns per annum. Okay. Now, I'm yet to hear a logical argument that tells me that's a bad return. It's not. It's a very good return. And even if you substantially underperform the market, and let's say you get 3% growth per annum over a 10-year period, that's still 12%, per annum over a 10-year, that's still 12% per year, and that's still 120% over 10 years. So even if you're getting about half of the industry average, you're still doing very well. But if we're getting the industry average, remembering we're trying to outperform that ideally, but even if we're just getting the average, over a 10-year period, you're getting 250 to 300%. So tripling your initial investment over 10 years, which means you're doubling your initial investment over 3 to 4 years. Now, what that means is effectively we've turned our 50 into 100 grand over 3 to 4 years, which means we can release that initial 50 grand through remortgaging and turn one property into 2, which means in 6 to 8 years, we can turn 2 into 4 and so on and so forth, just through an initial 50 grand invested. Now, if you're able to add an extra 50 grand every year or every 2 or 3 years, you can see the compounding effect that would have because you have multiple trees of growth. So that is why leveraged property investment is so powerful. And what that says to us is that it's not necessarily about maximizing returns. Because, for example, we could go and invest in the northwest of England, buy really cheap properties with really high potential yields, but also the vacancy rates are very high, the quality of tenants are lower, the chance of being paid is lower and the maintenance is higher. So the risks are higher. We could also go and invest in the sort of latest buy-to-let hotspots that haven't had any growth in the past, but will because of X, Y, Z. And maybe they do really well, or maybe they don't, or maybe they even do very poorly. Whereas we prefer to invest in central locations in major cities where we can tick all of the fundamentals boxes. Now, I don't cover those fundamentals in detail in this talk, but I will next week. Some of the key ones, though, is having a very large tenant pool and strong tenant demand, a broad range of industries that provide an abundance of employment, remembering that most of us live where we live because it's relatively close to work, facilities, amenities, and infrastructure. If we have an abundance of all of those things I've just mentioned, then there is very strong reason for people to want or need to live in our properties, both from a rental and a resale perspective, and that creates safety and sustainability of demand. So we want those things in abundance. We don't want to invest in properties that are going to double in value overnight. That's not the goal. The goal is, 5 or 6% growth per annum, which might seem not that much on the asset value, but gives us fantastic returns on our cash. Hopefully that all makes sense. But again, any questions, feel free to ask in the Q&A section ideally, or if it's very topical and you'd like me to answer it straight away, then you can answer it in the chat section. All right, where are we? Okay, so this is a graph from a report called Buy to Let Comes of Age. It was done by a research house called Ringlesworth in 2013. So it's a little bit dated. However, I think it's still relevant because it was over an 18-year period from 1996 to 2013. 1996 is when buy-to-let mortgages first became available in the UK. So it's a relatively new concept in comparison to some other countries like Australia, for example. And what it looked at was the returns on your cash invested across various asset classes. And this first one being the returns on your 25% deposit, being, for example, the 50 grand, into a £200,000 asset with a 75% leverage. So the example I gave of 50 to 200 isn't relevant, but this is the average across the UK on all 75% leverage properties. And what it returned was an average return of 16.3% per annum net over that time frame. Now, I mentioned 25 to 30. That's very achievable, but this, I suppose, is a little bit more conservative. Still a very good return. If we compare that to cash bought property, commercial property, shares, gilts, cash. So it has substantially outperformed and continues to substantially outperform all other asset classes. What I have added in here is another variant, which is the average return on capital from a privately owned non-financial UK business. So for business owners who might be thinking of reinvesting their cash in their business to grow their business, the average return on that cash across businesses in the UK was over that time frame 13%. So we've got here a passive investment generating a better return than a very proactive investment, something that you're working in a business, 5 to 7 days a week. So I think that's very interesting as well. And a lot of people overlook the amount of time it takes to make money in a traditional business versus the lack of time it takes to make money in property. So this is a point for business owners, but some of these points are also very relevant to employees as well that have spare resources and want to start a property business. So first off, what we have found is we deal with a lot of business owners who have spare funds in their business, retained profits that they haven't paid out to themselves because they don't want to pay 40 or 45% tax on that money. So it's simply retained in the business. And they're looking for what they can do with that money. It's probably currently sitting in a bank account, earning 0.5% per annum if they're lucky. You can set up a special purpose vehicle, limited company, for investing in property that runs alongside, let's say, company A is your current business, company B is the property business. You can lend the money from company A to company B. You own both companies, so you charge yourself a nominal interest rate, but it doesn't matter because you own them both anyway. And that keeps the cash in what is a tax-effective vehicle. You don't pay any more tax. You've already paid corporation tax on it, which is only 19% currently. Keep the money in that tax-effective vehicle, and you can invest it in property with leverage. So for example, we take 50 grand that's sitting in your current business, we invest it into a £200,000 property, and we're able to achieve really strong double-digit returns per annum. And if we're investing it right, that's quite passive. You don't have to do a lot for that money. You loan the money across. Quite often the returns on those funds would be better than the returns from your main business. Now that depends how profitable your main business is, obviously, but it's more profitable than an average UK business. So if you are the average UK business, setting up a property company can work really well. It's something that I've been doing for years. I pay myself what I and my family need to live comfortably, and anything spare goes into the property company, and I invested in property with leverage. And it's a really nice feeling to have built a portfolio of tangible assets that are growing in value and give a net yield, because any business can fail. You know, I'm acutely aware that, you know, I've got various businesses across property, e-commerce, health and fitness, whole range of things, but all of them could fail at some point. And if they do, and you're not left with anything, that could obviously be very demoralizing. The fact for a number of years I've taken my profits and put them into property creates safety. It means that even if my other businesses fail, I have this other business that isn't going to fail. They're tangible assets in central locations. They will always rent. You know, with the right types of properties, it's not the type of thing you lose money on. It's more about how much money you're going to make. So that's a really nice feeling. It creates safety for you and your family and mitigates the risk of your other businesses. It means you can control the release of funds, because if you're just retaining profits within a property company and reinvesting it, you don't have to take that money out until you want to. And therefore you're only paying 19% tax on it, which is obviously quite tax efficient. And what we're looking to do is create passive income from proactively made profits. So we're taking the money from your business that's profitable, or from your wages that you're able to save, and we're putting it into a tangible asset that's growing in value and giving a passive income, which is a sensible investment. And it means that we're taking cash that might be sitting in the bank, doing very little. And therefore, you know, human nature is to kind of find a home for money. You know, I know if I've got 50 or 100 grand sitting in my bank account, I'm thinking, what can I do with it? It's sitting there doing nothing. And, you know, sometimes you might buy a silly car or go on a silly holiday, which might make you feel nice in the short term, but it's not going to improve your finances. Whereas you put that 50 grand into a property, I think of that as forever money. You know, it's always going to be there. I'm not going to spend it on something else. It's going to make me some money. If I've invested well, it should make me quite a bit of money over a 10+ year period, but it's locked away, and it kind of protects us from ourselves. So David just asked, limited companies can't invest in residential. I think you've been misled there, David. Limited companies can definitely invest in residential. I have about 4 limited companies that are all invested in residential property. I think what you might be referring to is pensions. Pensions can't invest in residential property. Limited companies definitely can. And it's something that, in fact, the vast majority of people are now doing, since there's been some tax changes to higher rate taxpayers for property ownership and the tax deductibility of buy-to-let mortgage interest, which is referred to as Section 24. Slightly beyond the scope of this talk, but feel free to Google it, or, you know, ask me and I'll talk. Actually, I'll talk a little bit more about Section 24 at the end if you like. But yes, limited companies can definitely invest in residential property. Right, the snowball effect. So this is an excerpt from the back of my book. And what it looks at is the example that I gave you before, about 50 grand invested into a £200,000 property, growing at 5% per annum, and remortgaging every time there's 25% usable equity in the property. So every time the debt comes down to 50%, you remortgage out 25 to bring it back up to 75. We've used a more conservative net rent here. So I said 5 to 10% before. We've used 2.5. So very, very conservative. And what we have is the property value growing by 5% per annum, reinvesting the net income, which brings down the loan to value per annum each year, which means we start with 1 property. At the end of year 5, we've got 2. At the end of year 10, we've got 4. 15, you've got 8. 20, you've got 16. 25, you've got 32. And here you've got the tree of how that works. Now, that's just by investing 1 lot of 50 grand. as I mentioned before, if you're investing 50 grand a year or 50 grand every 2 or 3 years, you have multiple trees of this, creating new properties and creating more passive income. So this is very, very achievable figures. The driving factors being 5%, 2.5% net yield. You might be surprised about how many properties you can create within what seems like a relatively short time frame of 10 to 15 years, but that's very, very achievable. So what types of properties work best for passively growing a property portfolio? Key word here being passive. There's lots of different ways to invest in property. And by no means am I saying that our approach is the only way to do it, because it's not. But I am confident in saying that what I'm talking to you about, what I'll talk to you about now in a moment, is most suitable for people who are passively investing. And what I mean by that is most of our clients are what I would call mum and dad investors. They've got spare resources available that they want to better utilize. They quite often have a full-time job. They've quite often got a busy full-time job that takes up most of their time. They also quite often have a family that takes up the balance of their time, and therefore they don't have any time for a second job or to, buy a property and develop it, which takes a lot of time, effort and risk. So they're looking for something passive, like investing in stocks and shares, very hands-off. In that case, off-plan, new or near new property works best. Now, the reason for that is they are the lowest maintenance. New properties also come with a broad range of warranties. So you'll have a 2-year builder's defect period, which means everything is covered for the first 2 years. All the minor defects are all covered. You'll have a 10-year structural warranty, which covers the structure of the building, design defects, water ingress, all the more major defects. And all of your fixtures and fittings will be under warranty for the first 5 to 7 years. Things like your oven, your dishwasher, your fridge, they're all under warranty as well. So much lower maintenance, much less headaches. They have all the latest bells and whistles, so they're attractive to your target market, and therefore more suitable for passive investors. You also get to pick and choose the best of what's there. The transaction happens a lot more easily and a lot more quickly. And what I mean by pick and choose is what we often find in a development is that some properties are much better than others, but that's not always priced in. And that's some of the benefit that we can offer. It's not only negotiating the best price, but getting you the best of what's available. And that can be very beneficial in the long term. So what is your current situation, and therefore what is important? Now, this is a really important point that I find that some people get wrong. And I don't like telling people that they're wrong in their thinking. It's more about opinions, I suppose. But in this case, I'm quite confident in saying that our approach is right, because a lot of people's the end goal is income, and that's obvious. The end goal is to not have to work forever, and therefore they start out investing for income because that's their end goal. However, that is very, very limiting and may stop a lot of people actually achieving their goal. Well, certainly the average person anyway. And what I mean by that is, let's say I'm a first-time investor and I've got 50 grand to invest. If I take that 50 grand and I invest it in a strongly cash flow focused investment, so let's say I get a 10% net yield on my fund, which is pretty good going, that gives me 5 grand a year. But if that asset isn't growing in value at all, my income doesn't grow either. And therefore, the only way of adding more cash flow to a cash flow focused strategy is by investing more cash. So let's say my end goal is 50 grand a year. I start out with 5. The only way I turn my 5 into 50 is by investing 9 more lots of 50 grand. Now, for most people, saving and investing £500,000 is going to be very, very difficult. The average wage in the UK is about 30 grand. So that's going to be very, very difficult. But as that first time investor, if I take my 50 grand and I invest it into a £200,000 growth asset, it's something that we're confident is going to grow in value due to various factors, over a 10 to 15 year period, it's quite likely that property will there or thereabouts double in value. And therefore it's gone from 200,000 to 400,000. My equity has gone from 50,000 to 250,000. Now, if I can remortgage and reinvest to do that 4 times, I turn my 50 grand into $1 million. Now, if I was to say to you, I can help you turn 50 grand into $1 million over a 10 to 20 year period, you would have a lot of questions. But it's actually very achievable using leveraged property and investing well. And that's not by setting the world on fire. with regards to the returns, but rather simply getting average returns on the asset values, investing well, and remortgaging to reinvest. So question there, you've mentioned 50 grand. What if I have less than that and just 10,000? Okay, good question and relevant to my point. £10,000 is not enough to invest in property, unfortunately. I'm very honest about this. I don't have a magic wand. I can't help you turn 10 into 50 overnight. You have to be responsible for that. You hear a lot of people talking about no money down investing and all that sort of thing. Quite often that's a con. I would avoid anybody who spouts that as a strategy, especially for beginners. Now, if you're more experienced, if you have experience and you have a successful track record, it's going to be easier to raise money from others to invest in property. As a beginner, you're pretty much limited to family and friends. And even then, I would be wary about borrowing money from family and friends to invest if you don't really know what you're doing, because it's more risky. And you might lose the money and that might ruin the relationships with your family and friends. So to start investing in property, I'd say as a minimum, you need about 25 to 30,000 pounds to get started. And the reason for that is mainly because, in my opinion, there's not an awful lot worth buying that makes a good investment in a good area under about 100,000 pounds. Now, some people would disagree with me on that, but we like attractive properties in central locations in major cities. You can go to the Northwest or Scotland and get properties for 50 grand, but they're quite often properties you'll have issues with. In my personal experience and the experience of the thousands of investors I've dealt with. So 25 to 30 grand is probably what you need to be aiming for as a starting point. Where you get that from is up to you, and then we can help you go from there. So Addy, yes, you can get a £50,000 property at a 75% loan to value using 10 grand. But whether that property is worth buying just for the sake of it would be the big question mark. It's also quite limiting. A lot of buy-to-let lenders have a minimum loan amount, and quite often that's about sort of 60 to 100,000. So there's limited number of lenders who will lend to you on a 50 grand property, and quite often it wouldn't be a good investment anyway, and therefore you'd be better off saving a little bit of extra money rather than getting started based on what you have now. Hopefully that answers your question. Right, so when you have a smaller asset base, you need to grow your portfolio. Growth is the most important focus. When you have a large amount of money or enough to retire, the focus shifts toward income. Hopefully that makes sense. What is your end goal? So most people that I speak with, when we first engage with them, they haven't really thought about this. This is very important. It's one of the first things that our guys will do with you in that free consultation that I referred to, is help you determine what your end goal is, where you are now, and then reverse engineer to what the shortfall is and what you need to be doing to actually get there. But let's say your end goal is £50,000 per annum of passive income to live relatively comfortably. Now, I'd say that's probably the average that people say to us as a minimum to live comfortably, but I can't tell you what that figure is for you, because some people would spend 50 grand over 2 or 3 years and others would spend it in a weekend. So, it all depends on your lifestyle or what you want your lifestyle to be. So let's say 50 grand is the goal though, and you're confident in generating a net yield of 5%. Now you might say, well, Paul, I can get a net yield of 10%, and maybe you can in today's market. But is that sustainable over the next 20, 30, 40 years? And the answer is probably not. 5% is a lot more sustainable, a lot more conservative, and therefore I'd encourage you to use that figure, even if it's less than what you can get today. So 5% on £1 million gives you your 50 grand a year. So 50 grand is your end goal. You're going to need a £1 million investable asset base. So that excludes your home. It excludes all of your personal assets. It's solely investment assets that generate an income. So that could be, it could be £1 million equity in a £2 million portfolio. It could be cash bought £1 million. It doesn't really matter, and it doesn't even really relate to investing in property. But the end goal is £1 million of cash, property, shares, anything of equity that you can get a 5% yield on, which will give you your 50 grand a year. how you work that out is you take your passive income goal, you divide it by the achievable net yield. So in this case, 0.05, and that will give you your investable asset base required. A simpler way of doing it, if you're happy with the 5%, is if your end goal is 30 grand a year, add a zero and double it, which means your goal is 600 grand. If it's 100 grand a year, add a zero and double it, your end goal is 2 million. Now, I mentioned in the trick question at the start, how many properties will you need? And the answer is it really doesn't matter. I get asked this question all the time. What should my end goal be? Should it be 10 properties? Should it be 20? It really, really doesn't matter. It's all about what that does for you. You know, believe it or not, investing in property is not about bragging to your friends at dinner parties about how many you've got. It's all about what it does for your finances. So, you know, for example, one £1 million property is quite different, but also quite similar to 10 100 grand properties. One or the other aren't better. It's all about what it's doing for your situation. Do you have a growth strategy? Do you have an income strategy based upon the stage of life that you're at? My book covers that in quite a lot of detail about what your mindset and your strategy should be based on where you're at and your financial situation. All right, I'll stop sharing this with you now. So I mentioned about the free consultation offer. So you will all receive a text message and an email following this webinar, offering the opportunity to have a one-to-one consultation with one of our senior client advisors. Now, usually we do them via video conference. So usually we do them face-to-face in our office in the city. We've got an office in the City of London, Birmingham and Manchester. However, given the current situation, we're doing all of those via video conference. So you can do it from the comfort of your own home. Now, that's a full review of your current situation, your goals, your strategy, where you're at, what your goals are, and what the shortfall is. That's often quite enlightening in my experience. And also an understanding of our company and whether there's a fit there, whether we can add value. Now, usually if there is a fit, we charge a fee to engage with you and generate advice. The promotional offer I mentioned is we'd be willing to waive that fee. So that's usually £500 to £2,500, depending on the complexity of your situation. What we're offering is to waive that fee, not charge you anything to engage. We won't engage with everyone. There's no point wasting anyone's time, but if there's the potential for us to add value, we'll generate that advice free of charge, which on average is 10 hours work specific to your situation on how you can improve. So you'll get the text message, you'll get the email. All you need to do is reply to let us know that that is of interest, and we'll be in touch to organize a time. So hopefully, very little for you to lose there and potentially a lot to gain. So hopefully we can add some value to you there. I also mentioned about the book. So what I'll share with you now. So this is our website, nova.financial. I'll just share these links with you. So you can learn a lot more about us on the website. That's the link to the website. On the bottom, on the banner at the bottom of the website is a link to the book. So this is usually £15 plus postage on Amazon. You can get it here for free just by paying £5 for postage. So it goes through all of your investment options, not just property. As I mentioned, my background is financial planning, so I have a broad understanding of what all of your options are. It talks about the limitations of traditional pensions and why property investment can be a great way of supplementing or an alternative to a traditional pension to provide for retirement. So we'll cover a lot of what I've covered today in a lot more detail, and that is for the hard copy. So if you order that, we will ship it out to you and you'll have it in a few days. There's also an Audible version. So that's the audio book. So if you prefer listening to books rather than reading them, you can get that there. You better like the sound of my voice because I narrated it. So 3 links there, one to our website, one to the free book, one to the Audible book. You can learn a lot more on our website about us, but also about property investment. I host a TV show called Proper Wealth, which is on Sky, and it features on quite a few others. All of those are on there. We've got 2 podcasts, lots of educational resources. So feel free to check that out if it's of interest. Right, hope everyone's finding this useful so far. I'll get to your questions now. So, question from Paul, advice on the current market. So good question, Paul. And I assume this is coming about because there's lots of conflicting information about the current market. Obviously, the Chancellor has announced that we are currently in a recession, which means that the economy has gone backwards 2 quarters in a row. Surprisingly, well, perhaps not so surprisingly, but for some, surprisingly, the property market is doing really well. Now, some reasons for that. We had lockdown, which started in April. That slowed or stopped a lot of property transactions. So there was a big pent-up demand over a period of 3 or 4 months where a lot of people weren't able to transact on property. And then a lot of that has come back to the market as lockdown has been released. However, the fundamentals of property haven't really changed with the current economic situation, especially in good areas. So the main reason we're in recession was the economic lockdown. Business wasn't able to take place. That's what's caused the recession. The main concern following that is job loss. So there's already been some job loss. There'll likely be some more job loss as the furlough scheme ends. The areas that will affect most, and most economists and property people will agree with me on this, the areas that will affect most is locations with thin job markets. So not as many jobs or very industry focused areas where those industries are going to struggle, they will be affected most. And this happened in the last recession. In the credit crunch, jobs dried up in smaller regional towns and cities, and people had to go to the employment hubs to get jobs. And that will likely happen again over the next 6 to 18 months, however long all this takes. So therefore, investing in desirable properties in central locations is still a good idea, even in the current climate. And you quite often hear about people talking about the UK property market and predictions on the UK property market. It's going to go up by X% or down by X% over the next month or year. Now, I think that's a bit silly because it's almost irrelevant to you or I as an individual landlord, because we don't own or invest in the UK property market. We invest in individual properties in individual areas. And those individual areas are driven by individual driving factors. I'll give you an example. A location where I've just bought a few properties and our clients have bought a few hundred over the past 12 months is Digbeth in central Birmingham. So it's southeast central Birmingham. It's about 20 to 30% cheaper than the rest of central Birmingham. There is literally billions of pounds being spent there at the moment. Lendlease is doing a huge development which pretty much extends the city into Digbeth. You've got the HS2 terminal just around the corner, so that's the high-speed rail. The Commonwealth Games coming to Birmingham in about 18 months' time or thereabouts. So lots and lots of reasons for that location to do really well. And I'm confident in saying that even if the UK property market goes backwards over the next 6 to 12 months by, let's say, 5%, I don't think it'll be much more than that, Digbeth will probably go forwards by 5 to 10%. Because those driving factors are separate to the UK market. And that's what we look for, is individual microclimates that are likely to do well by their individual driving factors. So overall, maybe the property market dips by a few percent over the next 12 months. It doesn't really matter though. If you're a current property owner, you won't even notice it and it will recover. Hopefully that helps. Learn how to build a portfolio to achieve passive income in later years. Is it really a profitable venture in the current climate at all? How to source funds. Okay, David. So I hope that I've covered most of that in my talk about it being profitable, even in the current climate. Sourcing funds, you do need to have some of your own funds to get started in property. There's no doubt about that. And I have covered that already. Sourcing the balance of funds being the mortgages, we can help you with that. And that's not difficult. Buy-to-let mortgages are easy to get. They're much easier to get than residential mortgages, and they're not based upon your income. They're majority based upon the properties you're buying and the rental income those properties will generate. Okay. Cerise, what would be better investment, a house or an apartment? Good question, and a topic of hot debate. Both can work is the answer. It depends on the location. Now, we don't mind investing in either. We tend to invest more in apartments. And the main reason for that is we look at things from the perspective of finding the best possible location with the strongest driving factors. And then we allow that to determine the best property. So generally we'll find that it will be central or surrounding central locations that have the strongest driving factors. And therefore you'll quite often find that average household makeup is sort of 1 to 2 people. And therefore a 1 or 2 bedroom apartment is what makes the most sense in that particular location. Houses can make sense too. It just depends on the location you're investing in. And that's the type of guidance that we give to our clients in helping them determine the best location, the best property for that location, and therefore positioning themselves well. Question from Karen. Do you think the need to live centrally will change with new work arrangements, more people working from home? So Karen, I don't think it will reverse what is quite a long-term trend towards central living, because employment is only one factor that's driving that. I'll give you an now. Over the past 20 odd years, there's been a strong trend towards central living, and that is being driven by a generational shift more so than anything else. In the past, people got married earlier, they had children earlier, they were much more family focused earlier on in life. And that we're talking, you know, the baby boomers, for example. Younger generations today, that's not so much on their mind. They're getting married later, having children later, they're working longer hours, and they have much more of a focus on facilities and amenities being on their doorstep. Far few of them have cars. Most of them use public transport. They want gyms, bars, restaurants, cafes on their doorstep. And those facilities and amenities will be what drives where people want to live. So yes, some people may move to the country, and I'm sure you've read lots in the media because they love talking about it. I get calls all the time from people in the media wanting me to say that. And I don't say it, so I don't get quoted. You know, a lot of the time, and unfortunately, journalists write their own articles how they want to write them, and they just look for people that'll give them quotes. So that's one thing. Ignore the media. When it comes to property, ignore the media because they're quite often wrong. For example, the last recession, if you read the media or if you asked anyone, you know, the popular opinion in 2007, as the property prices were booming, is it a good time to buy? They would have given you a resounding yes. In fact, it was the worst time to buy. If you move on 2 or 3 years, as the market started to recover, everyone was depressed and all the papers were writing about how property is a terrible investment because it had fallen by X%. In fact, that was the best time to buy. Ignore the media. Buy good properties in good locations for the long term, and you can't go too far wrong. So to wrap up that question, Karen, I don't think that will reverse the trend, but it will put more of a focus on livable properties. So, you know, buying a dodgy, tiny little flat in the center of a city because it yields well because of its location, those properties won't perform as well anymore because there'll be less demand for them. There'll be more of a focus on more livable properties. So things like the direction of the property, hopefully facing somewhere south, southeast, southwest is better. You get more sun, more heat, all those sorts, more light in the property. You know, corner properties are good because you get much more light throughout the day. A spare room for an office. More livable properties will perform better, at least over the short term as we're in this work from home environment, than your unlivable properties just based upon location. Karen, is this only relevant if you are mid-30s to early 50s, not near pension age? So are you asking, I assume you're asking, what is the strategy I'm referring to only relevant if you're younger? No, it's not. Because I assume if you're close to pension age, you would have some funds available for retirement to allow you to invest and provide an alternative to a pension. So, you know, we deal with a lot of clients who are in their 60s or 70s that have some spare resources, or they have some resources they've taken from their personal pension, or that they've sold up from stocks and shares or whatever that might be. And we help them take that money and get as much yield from it as possible. Question from Corinne. If renting a £1 million house at 2K per month, is that a question, Corinne? If you don't mind just clarifying for me. You said if renting a £1 million house at 2K per month, only 24K per annum. Not sure what you mean. Are you saying that's unprofitable for the landlord? Because I suppose that's not a great yield. You're right, but I'm not sure what the question is. Karen asked, is there a maximum age you can invest? Really good question. I'm glad you've asked that one. So with buy-to-let mortgages, some lenders will lend to you up to the age of 100. So residential mortgage lenders will often only lend to you up to the age of retirement age. With buy-to-let, there is not really any maximum because most of us only live to our mid-80s. So no, there's no maximum age. Okay, so Corinne, so were you stating that is unprofitable and therefore why would you invest in property? If so, you just wouldn't invest in that property. There's a very broad range of properties around the UK. Some people believe that London is the only place in the United Kingdom. That's not true. There are other places and often other better places to invest. So for example, you mentioned a £24,000 income on a £1 million property. That would be a 2.4% yield, which is terrible. The average in London is 3.5. The average our clients are achieving gross on the asset value is about 6. So the answer is just invest in a better property. So David asked, interest only or cap and interest? Generally, when it comes to buy-to-let, you want interest only. Now, the reason for that is it's lower risk. You're committing to a lower payment per annum, per month or per annum, and therefore you have the flexibility to pay extra if you want to. Most buy-to-let lenders will allow you to pay up to 10% of the principal per annum if you want to, over and above the interest. However, whereas with capital and interest, you have to repay it, and therefore you're committing to a higher payment, and therefore it's more risk. So interest only is always better, but repay extra if you can. In terms of one property at 1 mil, thanks for asking. Yeah, okay. So Steve, going on about EWS1s, but currently that has killed the flat buying market as lenders are giving zero valuations, even on buildings under 16-meter height. All right, so Steve, you just need to, so we can talk about this point separately because most people won't know what we're talking about, but an EWS1 refers to a cladding report on the building. Obviously is only relevant if the building has cladding. Most new build properties come with it. All new build properties come with it, in fact. If the building doesn't have an EWS1, yes, that can be an issue because lenders are going to want it and you can't force it out of the building, or I think you can, but it doesn't kill flats. So long as you can get it, and any building can get it, you're not going to get a zero valuation. But I'm happy to go into more detail on that with you later on if you like. Question from Addy, learn how to build a property portfolio to achieve passive income in later years. Okay, I think we already covered that question, Addy, earlier on. Is Liverpool or Manchester a good location, student population, for example? Yes, most of my properties and our clients' properties are in Birmingham, Manchester, and Liverpool. Central locations in those areas are fantastic, not just for students. In fact, I don't rent any of my properties to students. They're all young professionals. Very sustainable market. They have an above average income. They look after the place. They don't create headaches. So yes, that can make a very good investment. How do you take care of off-plan property if they do not get completed? Well, you need to make sure they're going to get completed. So there is various protections that can be put in place to make sure an off-plan property is either going to be completed or that your deposit is protected. So we've never had a client lose their deposit from buying off-plan, and we have had some developments go wrong, but we always make sure there is a level of protection in place for off-plan buying. How are they managed, as my existing portfolio takes a great deal of time to manage? Okay, so David, obviously if you're managing the properties yourself, then yes, they will take time to manage them. We manage most of our clients' properties, and quite often because they're in similar locations, we'll have people on the ground that take all of that work away. So we charge 8% plus VAT to manage the properties. That's not expensive. It's below market. And you're much better off doing that than trying to manage them yourself, in my personal opinion, unless it's next door, of course. Joe mentioned, assuming town locations with amenities would be good also, not just in a city. In some cases, yes, Joe. However, they are higher risk because quite often town locations are driven by one industry predominantly or one company. Some examples. Swansea, about 10,000 people there were employed by Honda. I think they've just sacked about 8,000. Big impact on that city. And pretty well every major or smaller city in town is driven predominantly by one industry or even sometimes one company. So it's higher risk because if that dries up, so too does your demand. Whereas in bigger cities, you have much more diversity. You know, Manchester, for example, has 95 of the FTSE 100 companies based there, and a pretty substantial base there. So hopefully that answers your question. Do you think having a established will be better for property? Okay, so I think you've asked there. Do you think having a company established will be better for property investment rather than personal name? The answer to that question is it very much depends on your personal situation. So if you're a basic rate taxpayer, there's not much point in a limited company unless it's for other reasons. If you're a higher rate taxpayer, that's when it becomes time to start assessing that as an option. Another question, is it believed that apartments with single tenant, it is believed that apartments with single tenant is no longer as great given new tenancy laws compared with HMO? Your thoughts? Look, I'm sure some people believe that. Most of my properties are let on a standard AST. Others are on a single let, short-term let basis, so renting them out on a nightly or weekly basis. That's a good way of boosting your yield. HMOs can work. They don't always work. It's a big buzzword. They've been overdone in a lot of areas. They don't work in certain locations, and they're a lot more work. I don't have any HMOs because I'm not really interested in that much sort of hands-on type of investing, simply for the yield. I don't mind doing a bit of property development stuff. But, you know, HMOs aren't the only way to get a good yield from property. So Joe mentioned, you've touched on it already, but can you confirm your company is able to support an individual looking to invest not in a limited company? Yes, of course, Joe. Yeah, limited company is just one way of investing in property. But we work with individuals, whether that be in a personal name or through a limited company. Question from David, can you explain how the limited main company is the lender for the residentials? Okay, so if I have a company that provides cleaning services, company A, that company's making money and they've got some spare cash in that company. Let's say it's 50 grand. I then set up company B to invest in property, which is a special purpose vehicle for investing in property. I lend my 50 grand from company A over to company B. I own both companies. So I might pay 2% interest from company B to company A, but it doesn't matter because I own both anyway, so I'm paying me. That the 50 grand forms the deposit for buying property, and then I take a buy-to-let mortgage for the balance, investing into a 200 grand property, for example. And then I keep doing that, keep lending some money across every few years, keep remortgaging and reinvesting, and I build the portfolio out through company B. Hopefully that answers that question. And there's a couple in the chat section. Look, I hope everybody has found this useful. As I say, please do get in touch afterwards once you receive the follow-up emails and texts. I just copied and pasted there the link to the book again for anybody who might be interested in getting a hard copy of the book, and obviously the website and the audiobook is a bit further up again, but feel free to ask for that. Happy to send it to you. And I think I've answered all the questions, guys, but if there's anything else that's outstanding, feel free to follow up. Hope you found this useful. I hope you have a great day. Everyone's happy and safe, and hopefully we can work together at some point in the near future. Addy, we can send the link via email if you like, but the link is just there in the chat section. I've just copied it over. But feel free to ask if you don't have it following the webinar. Thanks very much for your time, and Hopefully we get to meet at some point in the near future. We might even get to shake hands. Believe it. Imagine that, we get to shake hands again. All right, guys, I'm going to end the webinar now, but thanks for your time.